I started out in accounting at a community college, and I can remember the night before my first test, and I was stressed out. I didn't know if I was going to be able to pass because some of the concepts about debits and credits were not making sense. If that is you, if you're coming up on the first test and you're not sure, you have found the right video. We're going to go through what we've often find in Chapter 2 of Accounting 1 classes, debits and credits, T accounts, normal balance, and what all of those mean, and maybe some good ways to remember so you can not just survive your Accounting 1 class, but you can crush it and you can accomplish your academic or even career goals. So stick with me and we are going to go over Accounting 1, debits and credits, often found on Chapter 2. First of all, we have the T account. The T account is a really important part of accounting, but it has two words that we see in accounting that don't often mean the same thing as we think of them in other parts of life. We have debit and credit. In normal life, there's the debit card, right? This is the card that you swipe and it comes directly out of your bank account. And then there's the credit card. You know, the one Dave Ramsey says never to use. And when you use that one for whatever you want to buy, it doesn't come directly out of your account. It goes into another account that you have to pay later, but no money comes out of your account. That is debits and credits, normally what we think about. But in accounting, these are totally different words. And so you have to kind of forget that the normal ways that you think about debits and credits, and instead debit just means the left side of the T account and credit just means the right side of the T account. That is all those two things mean. So when you see a normal bank online app, you pull up your bank account. I wish this was mine with $28,000 sitting there in the bank. This is just one I found, but you usually see a balance and then either an addition or subtraction from that and a running balance. This is a single entry check register, but in accounting we have double entry accounting, which means for every transaction there has to be two entries, two sides of it. Because if you remember from Chapter 1, every time we have a transaction, we have to keep that accounting equation in balance. We can't just have one side, the assets increase or the liabilities increase. We have to have both sides of them always stay in balance. That accounting equation always has to stay in balance. And so what we have in starting in Chapter 2 is starting to talk about double entry accounting. And there are 12 facts that you have to remember to really do well in this Chapter 1 through Chapter 4. And really, these are what are going to set you up with a good basis. It's not a ton of information. It's just 12 simple facts that if you can memorize and you can be quick to remember, you are going to be miles ahead when you are doing Chapter 1, Chapter 2 tests or homework. So the first one is that each of these accounts have the debits and the credits work in different ways. And so some accounts, a debit increases the balance. Some accounts, a debit decreases the balance. And so these 12 facts, what accounts are increased with a debit or credit, are going to be so helpful for you to know. First fact is an asset increases with a debit. When we debit an asset, it increases that amount. And so when the business gets cash, the first rule is we debit cash. Now that does not sound right, because if I'm debiting my account, it feels like I'm taking money out of it. But in accounting, when we debit cash, that means that money is coming into the business. It is raising the balance of cash. Likewise, and for an asset, number 2 fact you have to remember is that assets decrease with a credit. So when we spend cash, that is a credit to cash. That's a little counterintuitive, but that's important to remember. That's facts 1 and 2. Facts 3 and 4, that liabilities work a little bit different or in reverse of assets. They increase with a credit and decrease with a debit. So that means that say that we buy an asset like equipment and we buy it on account, meaning we're going to pay for it later. That increases the asset of equipment and it increases the liability of accounts payable. Number 3 fact is assets increase with a credit, liabilities decrease with a debit. That's facts 3 and 4. Facts 5 and 6. Owner's capital account. It increases with a credit and it decreases with a debit. In accounting 1, you can totally forget about fact 6. You are not going to have to decrease the capital account except for extremely rare situations, but it increases with a credit. That means when the owner puts money into the business, it increases cash, a debit to cash, and a credit to the owner's capital account, though it increases with a credit. Facts 7 and 8, the drawing account. The drawing account is when the owner takes money out of the business for their own personal use. So the owner wants to pay themselves or get money out of the business, and so they use the drawing account. That increases with a debit, it decreases with a credit. It works very similar to expenses. Revenues, fact number 10, they increase with a credit and decrease with a debit. So if we go, we're a service business and we go perform work for somebody else, we get cash, we increase the asset of cash, a debit, and we increase the revenue of fees earned, a credit. And so we have a debit and a credit for these. Fact number 9 is revenues increase with a credit. Facts number 11 and 12, the last two, expenses increase with a debit and they decrease with a credit. If you can know these 12 facts, you're going to be doing really well in this class. One last thing that we need to go over before we dive into a problem is that a normal balance is the side that it increases on. So an expense like rent expense, its normal balance is a debit balance. Say we have something like a revenue like fees earned, its normal balance is a credit balance because that's the side it increases with. The drawing account has a normal balance of a debit because that's the side it increases. So we're going to go through a problem that's very similar if your class is using Cengage. It's very similar to Chapter 2, several Chapter 2 homework. It'll ask you which side increases, which side decreases, what's the normal balance, and what type of account is it. And so let's start here with the cash account, and we're going to go type of account first. And so the type of account, and I'm going to put a link to a Google Sheet that you can go through and test this yourself, but a cash account, that is an asset. And if it's right, we're going to get a green dollar sign there. If you're working with Cengage, green check marks. I like dollars better than check marks. And so we got a green dollar sign. We know that's right. Accounts receivable, that is also an asset. Hit the wrong button. That is also an asset. Accounts payable, that means we owe another entity, another business, somebody else. That is a liability. Fees earned, that's the result of us doing what we do in this business. If I'm an accountant and I do a tax return, or I give somebody a tax opinion, or I prepare financial statements for somebody, that is fees earned, and that is a revenue. Supplies, that is something we own, so that is an asset. Rent expense, well, it's an expense. That's what's great about expenses. They always have the word expense right in them. Matt Douglas Capital, on my books, that is an owner's equity, and the drawing account is also an owner's equity account. And finally, insurance expense, well, that's right, it is an expense. So what is the increase side of each one of these? A cash, it increases with a debit. and then it would decrease with a credit. And its normal balance is always going to be the same as the increase side. So in this case, it is a debit. Accounts receivable, also an asset. It is going to look exactly like the cash account, because all assets increase with a debit, all assets decrease with a credit, all assets have a normal debit balance. And a liability account, such as accounts payable, is going to increase with a credit. It's going to decrease with a debit, and its normal balance is going to be a credit. The fees earned account, that's a revenue. It is increasing with a credit, it's decreasing with a debit, and it is going to have a normal balance of a credit, because it's always the same as the increase side. Supplies, that's an asset, so it increases with a debit, it decreases with a credit, and it has a normal balance of a debit. Rent expense, that's an expense, and so it increases with a debit, it decreases with a credit, and its normal balance is a debit. Now the capital account, the actual owner's equity capital account, the rights of the owner to the business, that is a normal balance, and increase of a credit, decreases with a debit. The opposite, or what works inverse of the owner's equity account, is the drawing account. That's when the owner takes money out of the business. That increases with a debit. So every time the owner takes money out of it, it debits the drawing account, and it decreases with a credit, and it has a normal balance, always the same as the increase side. And then finally, we have our insurance expense that increases with a debit. All expenses increase with a debit. The decrease is a credit. And finally, the normal balance is a debit. All green dollar signs, beautiful, nice. I hope this video has helped. In the next video, I'm going to go over journal entries. If you're struggling with, what do I debit? What do I credit? I don't know how these journal entries work. Make sure you click on the next video, and we're going to go through that. I hope I'm helping you pass your accounting class. I hope that I'm helping you to reach your goals. If you have a problem on homework, or you're struggling with a concept that doesn't make sense, drop it in the comments. I'm happy to answer questions. I'm here to help you accomplish your goals.